Can't read it. I'll explain through this very quickly, but we really think this is kind of the most important chart about Nigeria. This is the world's 30 largest economies, and they are listed across there by the growth rate in population and the growth rate in working age population. And on your far right, you can't read it, but Japan and Poland, or Poland actually the furthest right, have a shrinking population and shrinking faster even working age population presents real economic challenges. Now on the far left, you can see there's a bar that stands out from all others. That's Nigeria. It's not just that Nigeria is growing faster in working age population and population than everyone else. It's growing faster by a lot. And you can see the gap between the most furthest left two bars and the next two countries, which are Pakistan and Egypt. Now the result of this is that Nigeria is going to be the fourth largest country by population, fifth largest in 2025, the fourth largest in 2035, and the third largest in 2045 roughly. Now I think everyone in this room should reflect on that a minute, because for all of us in our entire life there's only been three largest population countries, which are the United States, India, and China. There's been one change in the order of it, but that's going to change in our lifetime. And it also means, at the end of the day, I mean, I often talk to clients and they say, you know, Ghana, Tanzania, Kenya, Nigeria, let's have a conversation about the relative merits of investing. And my response to that is, well, the economy in Lagos is already twice the size of the entire economy of Ghana, so it's not a very long conversation. Now, and I first went to China in 1983, which at that time had not a single private car. I spent 10 years living in China and witnessed the greatest transformation in economy in the history of humanity. We are on the cusp of effectively exactly the same thing in Nigeria. This is the biggest economic story on the planet. Now let's take it a little closer to home in terms of time. What this shows is the just the basic GDP growth rate over the last 7 or 8 years. You can see back in the early 2010s that the growth rate was quite high. The yellow line is the population growth rate. So we had a number of years, oil boom years, where GDP per capita was increasing robustly. Not necessarily good enough inclusive growth, but broadly people were better off. We then had 4 years where we grew faster than the population growth rate, but not by much. Unfortunately, we're now in a period of at least 4 years where the growth rate is below population. And in fact, we had an outright recession in 2016, which meant that GDP per capita shrunk by 4%. But one question I think we all need to ask ourselves is, how long can Nigeria continue how do you function from a social viewpoint with declining GDP per capita? So, the message here is we need to get our growth rate up. And our house line at PwC is 5% is good, better than 3%, better than 0. But really we need 6 to 8% growth per year in order to significantly reduce poverty, increase incomes across Nigeria. Now you might say that's high, but the truth is China grew at 10% a year for 3 decades, and this is eminently achievable. And I actually think Nigeria could grow at 10% if it did a few right things. Just taking it in the short term, I think the governor and the minister both mentioned this, there being an Oscar, very positive movements in the last few months in terms of the macroeconomic fundamentals. We have moved from a recession into positive, not enough, but still positive. Reserves have increased, balance of trade, even at oil price $50, $55, we have a positive balance of trade. So this is all encouraging, as I would call it, a foundation or a base for the liftoff over the next period. But our biggest challenge is our investment. So what this slide looks at is the level of gross capital formation for 3 economies, for China, India, and Nigeria. Unfortunately, the bottom line is Nigeria's. The middle line is India's, and they have gross capital formation of roughly 30%. Basically, 15% gross capital formation means your economy won't grow because it's gross capital formation. It's just replacement of your depreciation. And you can see that people are able to read, but we're only at around that sort of 12 to 15% gross capital formation. And in fact, during the years when we had the higher GDP growth, we still were not investing enough capital. Why was our GDP growing? It was a consumption-led boom. But the money was either consumed, we were the biggest market for champagne for a while, or it was diverted. Unfortunately, it was not invested. So we're now in a position where we have a massive investment gap. And basically, our view as PwC is we need investment roughly in the order of 26 to 30% of GDP to drive that 5 to 8% growth number. Now, how does that fit in with the capital markets? Well, basically, we only have about half of that amount of money available domestically. So if we think in Naira terms for a minute, we have a 100 trillion Naira economy. We need investment, as I said, 26 to 30 trillion Naira. We only have half of that. So we need from the outside 13 to 15 trillion Naira. And Alice will talk in a minute about the capital markets, but there's FDI and foreign portfolio investment. At least half of that has to come from portfolio investment, foreign portfolio investment. So we need the capital inflows from abroad to be able to reach the GDP growth that's required to in a sense, grow the economy faster than our population growth. Now, one thing that I'll just end in a minute before turning it over to Alice, I think one thing that's very critical to understand about the Nigerian economy is that many people in Nigeria have a misconception about the potential role of the government. And the Minister of State mentioned it this morning, her belief in the private sector. I think Oscar mentioned it, the governor mentioned it. We very strongly, just mathematically, it's not possible for the government to make a huge difference in terms of the capital required. So this looks at expenditure and inflows. And the basic message here is that the government in its economic recovery and growth plan has committed about 2 trillion Naira in capital expenditure. Now, I said a little bit earlier that the required capital expenditure is 26 to 30 trillion Naira, which means that the federal government is at best, if it's able to follow through on this commitment, only able to supply less than 10%, maybe 8%, 7-8% of the required capital. The rest, and the states have very little money, as you know. So the rest of that capital has to come from the private sector. It's why issues around ease of doing business, about the war on corruption are so critical, because we won't attract that capital unless we do it. But the other thing I wanted to highlight with this as well is that one of the major things, I said before I pay 21% interest on my mortgage, and which I won't dwell on. And of course, we're sitting here in a situation, we have here the new Director General of the Debt Management Office, a very distinguished lady who's doing a fantastic job. And we're sitting here, and we will supply all these numbers, but we all know that GDP, that the debt to GDP in Nigeria is very low. It's below 20%. It sounds like a fantastic, strong fiscal position. But why is it that we then have these very, very high interest rates? The basic issue from PwC's viewpoint is that Nigerians don't pay their taxes. So we're sitting here, we're only collecting, if you go back to those numbers, so we said there's expenditures of 7 trillion Naira at the federal level, and there's inflows of 5 trillion. So we have a 2 trillion Naira deficit that we're financing at these very, very high rates. And we don't have sufficient domestic savings. So if you remember, I said it was a 100 trillion Naira economy. So how is it possible that we're only collecting 5 trillion Naira? We're only collecting 5% of our GDP on that. And so the issue of the high interest rates is not, is in our view, simply an issue of many wealthy Nigerians and company leaders not paying their taxes. In South Africa, the tax collection is about 25%. In Kenya, it's about 20%. We don't see any path forward without significantly closing this gap. Now, how's that related to interest rates? Well, if the federal government has to borrow 2 trillion Naira, it's a classic crowding out of the private market. And if the government collected a reasonable amount of taxes, its borrowing requirement would be much, much less. So I remember on my blog, and last comment before turning over to Alice, but when the governor was summoned before the assembly on this issue, and he was asked the question, why are interest rates so high? I asked the question in my blog, well, could everyone asking that question of him in the Senate tell us how much tax they actually paid on that? And there's a relationship between how much the federal government has to borrow and what they're able to take in. So that's some basic mathematics around the macroeconomy. I hope that helps the discussion. What I'd like to do is turn it over to Alice and dive a little deeper into what's going on in some of the capital markets and how that fits into the future for Nigeria's economy. So thank you.
Right. Before I kind of move on to my section, if I can just put in my vote for the local currency bond. I think Nigeria's neighbor to the east has better jollof, so I will vote for a Niger bond. Cameroon goes by under the radar for the best jollof, but I think we do have the best jollof. Okay, so just to follow on what Andrew was talking about, and I think the theme from this morning's session and a lot of what has been said, there's been a significant strain, I think, on the government. This is kind of what Andrew alluded to. The government has really worked, especially on the fiscal side and the monetary policy side, to get Nigeria out of the recession, and in that process essentially crowded out the private sector. Private sector has seen pretty much no financing. Banks have been closed to the private sector. FDI has reduced significantly, as you see here, and same for foreign portfolio investments. But I think what you see on the next slide is we've seen a significant increase in foreign portfolio investment, which is a good story for Nigeria. Our view, at least at PwC, and there's a lot of debate out there on FPI and whether it's good or bad, but we believe FPI is very important for Nigeria. And as Oscar mentioned, we had a scare earlier, I think last year, when Nigeria was about to get out of was at least shortlisted to get out of the MSCI Frontier Market Index, and I think that's a good thing for the secondary market in Nigeria. If we now move to here, and we at PwC too we're not scared to take on controversial topics. I think the big thing that we need to see, I guess, in the private sector is more funding locally by the domestic investors. And the good news, and I'm sure the DG at DMO will mention this, but Nigeria is refinancing a lot of its debt, and the good news is hopefully some of the pension assets will be released for private sector investment. Hopefully we'll see more IPOs. I'm still waiting to work on my first IPO in Nigeria. It's been 2 years in the waiting. So if you look at, for example, P7, which is essentially the 7 largest pension markets in the world, there's a huge allocation to equities. And what we are thinking is we're looking for a day where Nigeria pension assets will essentially be allocated to equities, which would be big for our private sector and financing the growth that Nigeria needs. And then moving on here. So here what we're looking at is, if you look at the current, the size of our current, I think as the latest data from NBS is essentially 7 trillion about pension market. And we estimate, and there's different allocations and buckets and all that, but we estimate about 2.3 trillion of that should be available to corporate equities and bonds, yet we're only saying much less. So there's a huge gap of about 2.3 trillion that we believe should be essentially funded towards investing in corporate securities. And right now, that's essentially not being tapped into. So hopefully with the refinancing by the government, we'll see some more allocations to corporate securities. Lastly, what we get at here, which is kind of what Andrew was alluding to, if you look at asset to GDP ratio in most economies, especially South Africa, Kenya, and other emerging markets, the sweet spot for pension assets to GDP ratio is right around 20-25%. Right now in Nigeria, we're only about 5%. And talking about the population growth that's happening right now in Nigeria, we not only need our pension savings to increase and I know DJ of PENCOM is not here, but there's been a lot of work around, for example, the micro pension plan, which we think is great. But in order to support the growing population and to finance the much needed investment, especially in the corporate space and the private sector, we need to see our savings grow. I hope everyone contributes to the pension fund, the contributory one at least in Nigeria. And we need to see that growth to essentially help bridge that gap between what Andrew mentioned around if we're trying to achieve a 7% or more GDP growth, we essentially need the domestic investors to play their role. And the second point on this is we also believe if you look at a partnership such as that between the Nigerian Stock Exchange and the London Stock Exchange, where hopefully we'll see more and more listings, dual listings, local currency bond issues and all of that, and coming up with really nice and innovative products, we need the domestic investors to essentially support foreign investors in this space. And we saw, for example, with Seplat, with I think almost 50% domestic investors invested in that IPO. But in order to sustain these relationships in the long term, we really need to see a little bit more growth in the domestic savings market to continue to sustain relationships which are critical to bringing Nigeria to the international and global space. So I think that's all for us.